Okay. So we are going to do about your risk and return.
Okay, ma'am.
So you write the topic this from here. See, what are risk and return? So any financial decision you are taking, why you are taking that financial decision? Because you expect some return from it. Okay. So now when you have some return expectation of some return from it, remember there are also risks with every investment involved. Different type of risks coming from your market risk, your default risk, whatever the risk we have, but different type of risk are involved with every investment of yours. So here what we are going to do is, first we'll go to find the returns from the different assets, then gradually we will inculcate the risk involved with the different type of investment. So let us start with here, return on a single asset. So what we are going to do is a portfolio investment. Portfolio means, of course, suppose you as an investor, you don't invest only, suppose you are keeping all your money in the saving account, then you are no investor at all, because your money will never see growth. If you are investing all in FDs or all in some say recurring deposit, again you are not a good investor, in the sense that you have not diversified your portfolio, you have not expanded your portfolio. Whatever return, little return you will get from a single investment is all that you will get throughout. As an investor, we should know how to create a portfolio. Portfolio means different type of assets on which you have invested, and how to diversify them so that your return will be maximized. And if there is some losses due to market fluctuation in one asset, the investment in the other asset will make up for that loss. A good portfolio will always go on giving you a steady return. Even if there are some ups and downs in one type of asset, your return from the asset will go on paying for them. Okay. Nikhil, you are here.
Yes, ma'am.
Okay, we have just started. So this is all that you have done, just one there. So started with risk and return. So from here we are doing. So we are going to calculate today the risk and return of a single asset. We'll start, expand it to two asset, and then we'll create a portfolio. Okay, this topic will help you greatly if to write any future paper on finance. So starting with return on a single asset. So let us take an example from here. We will calculate the return on a single asset. Suppose let the par value of a share of a company. We have already done how to calculate the share prices and all. Valuation of the shares we have done in the last previous classes. So here let us take a calculation. We proceed from here. Calculation of return on a single asset. Okay. So say that single asset is a share of a company. So the par value of a share of a company, say it is 10, and you have invested 100 share at a price of 225 per share. So what will be your investment? How much you have invested? 225 per share into 100 share. Your investment is 22,500. Fine.
Yes, ma'am.
Okay. So go on writing with me, along with me. Okay. So see, from here we are going to expand it to two share, then multiple share, then portfolio. So here we start with a simple example in which we have a single asset. Okay, which is a share. Par value is 10. 100 share you have purchased of that company. When you purchase, the price, market price was 225 per share. So what you have done is you have invested a total of 22,500 on this share of the company. Now, what is your dividend return? So your dividend return is how much? It is, you already know how the dividend is calculated, valuations you have done. So your dividend is announced as a percentage of your per unit share. Okay, for example, the company may give you 100% of the dividend, or last class also we did retention ratio, where the company may decide to reinvest the part of the profit without giving you 100% of your dividend. It will give you some and reinvest some. Suppose the company decide that you are to be given 25% of the dividend in this year. Okay, so remember, dividend is always calculated on the par value. So how much dividend the company is going to give you is 25% of this par value. Par value is your 10 of this share. So you have a dividend of 25% of 10, which is your 2.50. So what is your total dividend income you are going to get for a year? Because you have purchased 100 share. Okay, so your dividend earning is your dividend per share into the number of share. Okay, so it is your 2.50 equal to 250. So your dividend income is 250. Have you written this? Write
Yes,
this.
ma'am.
So I repeat, your dividend income is dividend into par value, because 25% into 10 into number of share, which is your 100. So it is your 25% into 10, which is your 250. 250 into 100 is your 250 is your total dividend income. Till here you have understood. So when you have invested in the share, you have two type of return. Already we have done. One is your total investment from the share, which you will get because of the market prices. Okay. Other is the other part of your investment in share is your dividend income. You get two cash flow from your investment in the share. One is your share prices valuation, which you have done in the last class. Other is your dividend valuation, which you have also done. So your total investment from the share is a summation of these two type of income. Okay, one is from the share price, other is from the dividend. Done till here?
Yes, ma'am.
Okay, so let us proceed. Now, what is the capital gain or loss you have got? So now suppose at the end of the year, you want to sell the share. And when you are going to sell the share, you see that the market price is 267.50. So what is the capital gain or loss? Your formula for capital gain and loss is your selling price minus your buying price into the number of shares. So your selling price is your 267.50. Okay. So this is when you are going to sell it at the end of the year. Suppose the price is 267.50 minus your buying price was how much? What was your buying price?
250. 50.
250 was the buying price. 250 was the dividend. Your buying price of the share is how much? 225. You purchase 100 share at a price of 225. Yes or no?
Yes, ma'am.
Again,
Yes,
be conscious, because this single example we are going to go on extending. Again, I repeat, when you purchase the share, the price was 225. You purchased 100 share. Okay. So that means in the share, you have invested 225 into 100 number of share, which is 22,500. This is one part of your cash flow. Other part is you get a dividend from the company as well. That dividend is some percentage of the par value it announces. In this case, for example, 25% it has announced. So this 250 is the dividend income. Okay. So your capital now in the overall, you got a capital gain or loss from the dividend income is 250. But on your share prices, this part, you got a capital gain or loss we are calculating. So when you went to sell the share, the price that day was 267.50. So what is your capital gain or loss? The formula is selling price minus buying price into the number of shares. Okay, so per share is how much into number of shares. So in this case, you can see when you purchase the share at 225. And now when you are going to sell the share, the price is more. So what you have done is you have got a capital gain, because your selling price is more than the buying price. In that case, you will have a capital gain. How much is the capital gain? Calculate.
4,250.
4,250. How did you calculate that?
Ma'am, 267.5 minus 225 into 100.
Into 100. Very good. So let us go to the both. Both of you have done, Amata.
Yes, ma'am.
Yes, ma'am.
Because this Nikhil knows here does the class. Okay, and I'm writing it here once. Okay. So in this case, remember, if your selling price is greater than your buying price, If your selling price is greater than the buying price, then in this case, you will always have capital gain. There will be capital gain. And if your selling price, I write it in short now, is less than your buying price, then you have your capital loss. In that case, you will see that you have a capital loss. Your dividend income is different. This is on your share, from the share price only. Okay. So in this case, you have a capital gain. So capital gain is how much? You got a capital gain, which is your selling price minus your buying price. Okay. This is your into 100 number of shares you have got. So this is your into 100. So that gives you a total 4250. Now, what is your total return you got now? What is your total return from this investment in this 100 share? What is the total return you got? Total
4250.
This is from only the share. Total return is, now you will sum up, is your dividend income from the dividend.
4,500 it will be.
Yes, plus the capital gain or loss you got. Gain or loss is your total earning from the investment in this share. So your dividend income was 250 you got, and this you got as from the share prices you got this. Total return was 4500 from your investment in this 100 share. This is the total gain you got from your investment in the capital, in these 100 shares. Done.
Yes, ma'am.
What is the total receipt? Now, this is, remember, this is your total return. Okay, this is your total return. So, moving on, what is your total receipt? Suppose your question is, now you sold the share. You sold these 100 shares in the market. What will be your total receipt at the end of the year? Okay, find total receipt at the end of the year. Now, when you have sold this 100 share, what will be your total receipt at the end of the year? So, in this case, your formula will be dividend income plus the sale proceeds. Sale proceeds. So, your dividend income already you know, this is your 250 plus what is your sale proceeds? Sale proceeds is your per unit price
4,200.
into your 100 number of shares. How much is this? So your total sale proceeds plus dividend income is the total receipt you got from this 100 share. What 4,500 you calculated was only
Sorry.
your, yes, tell me.
27.
It is 27,000.
27,000. Okay, and you can see what is this 27,000. It is simply the summation of your earlier investment and total return. So what was your earlier investment? So this is, you can see this 2700 is nothing but this is equivalent to your total investment on your share, total investment on only the share plus the total return you got. Total return you got. So your investment on the share was how much? 22,500 plus your total return from this, how much you got? To 4500. How much is this coming to?
7,000.
Is 27,000. So you can see this is this minus this, your earlier investment is your return. Any way you go, this is what you got. So your investment on the shares, then your total return your total return consists of both your dividend income as well as your capital gain and loss. This is your 4500. So 4500 is your income from the dividend income as well as your the capital gain and loss you got. Okay. So how much now? Next question is calculate how much is your percentage return on your total investment. How much is the percentage return on your total investment? So a percentage return, how much in percentage did you get is your total return you got whole divided by your initial investment. Initial investment, how much is that? Calculate.
20%.
20%. So what you got is total return is 4500. Earlier investment was 22,500. So that gives you 20% return you got on your investment. Okay. Done all of you?
Yes, ma'am.
Okay. So let us proceed. So next is we'll calculate the rate of return. Rate of return calculated on per share basis. Per share basis. In this case, your rate of return, okay, which I write it as R, rate of return, will be given as your dividend yield plus the capital gain and loss you got. Capital gain or loss, or let us call it as capital gain yield only. Need not, because that can be positive or negative. Negative will take care of the your negative losses. So we write it as capital gain yield. One part will get what your total return is your dividend yield plus the capital gain yield. So your dividend yield is written as formula is dividend in year 1 with the initial share price plus this capital gain yield is your share price in current year minus share price in the previous year divided by share price in the previous year is your formula, where your DI is, sorry, DIV1. DIV1 is dividend received per share in year 1. P0 is price of the share in the beginning of the year. Price of the share in the beginning of the year. Beginning of the year. And next is P1 is price. I just put a ditto sign, you can write, of the share, okay, at the end of the year. At the end of the year. And just the reverse, your P0 is at the P0 is, we can change this as P1, this is your P0. I repeat, your P0 is at the beginning of the year, previous year, and P1 is at the end of the year. For example, now suppose you are going to calculate it now at year 2023, then this will be your P1 and P0 will be the previous year price. Have you done?
Yes, ma'am.
Using this, calculate rate of return of the example we have taken. Use this formula to calculate the rate of returns of the example we have taken and tell me. How much did you get?
Ma'am, what was the selling price of the share?
Selling price was 267.50. You have calculated same example.
Okay, ma'am.
Buying price was, let me write it at the side. So your buying price, which is your P0, was 225. Selling price was 267.50. Okay. Your dividend per share you calculated was 250. So whenever you have investment in the share, you have two returns you will get. One is your dividend yield, the yield you will get from the dividend. You express it as a percentage of your share price per unit share. Yes.
Ma'am, it is 1.3.
1.3. So your rate of return, I write it as RR. Okay. Your rate of return, which is given, is dividend per share 250 to the initial share price 225. This is your 267.50, 225 to 225. This is your total return from the share. How much it is coming?
1.3.
No. Calculate again. Overall is how much? How much?
Ma'am, is it 250 or 2.5?
Why? How much is this part?
That is
This much or not?
just a second.
How much is this part?
Yes, ma'am.
And this part?
Ma'am, it is 0.20 rate of return.
No. Total rate of return, right? Oh, you are telling me the answer. Yes. 189. So how
Yes,
much
ma'am.
you got is 0.20, which is your 20%. Did you match your answer earlier? You got the same thing here with this formula as well.
Yes, ma'am.
Okay, so this is same thing. Here total return divided by initial investment. Here what you have done is how you got the total return. What was this? It was simply your summation of your dividend income and your return from the share, no? Capital gain and loss. Isn't it? 250 plus 4250. This
Yes,
was
ma'am.
your total return. This is just another way of expressing that. Here instead of total, you have done separately, you have calculated. This plus this is your total return. The same way you have calculated. Same thing you have done. Another way of getting your total return from these shares. How much when you're investing, how much are you getting back? And that consists of two parts. One is your dividend income, another is your return from the share, capital gain or loss. Okay. So we'll go back. So now suppose in this example, you can see you purchased the share at 225, and when you went to sell the share, selling price was 267. And because your selling price is greater than buying price, what you got as you got a capital gain. You had a capital gain here. Okay. And you also calculated the overall return, which was 20%. Remember, in this, what you observed is your dividend income is remaining constant. What is volatile or changing or fluctuating is your share price part. So one side you have a secured income, which is in the form of share of the dividend. Okay, even if it is not paid, it gets cumulative retained. Next year you will get. and but the volatile part is this part. Okay, this is a volatile part which keeps fluctuating according to the market price. Okay, so let us proceed. Now assume that the share price is rupees 200. So your purchase price, remember your buying price was 225. Same example, 225. Now when you went to sell the share, your selling price is rupees 200. This is your selling price. So if you have a selling price of 200, calculate your return on your investment. Calculate the percentage return on your investment. Calculate the percentage return on your investment. So in that case, the share price has increased, you got a 20% return. Now, if your share price has fallen, everything remaining same, when you went to sell the share, the price is now 200, then calculate your percentage return.
Minus 10%.
Is your 10%. Very good. Both of you got. So what we do it, let us solve it. So this is your return. Rate of return is given as your dividend income, which is not fluctuated. It has remained same. What was fluctuated is your return from the market price of the share price, fluctuation in the market price of the share price. So this is your, this part is same as before, no fluctuation. What has fluctuated is this part, which is you got as 10%. You got a negative. So there is a 10% capital loss. There is a 10% capital loss here. And how you got the capital loss? Because you can see in this case, your selling price is less than buying price. Whenever your selling price will be less than buying price, you will have a capital loss. Have you done?
Yes, ma'am.
Okay. So let us go back to the PPT once. You can see the PPT now. So this is what you have just already you have done. So what is the capital gain? You have calculated this to be 4250. Then what is your total investment, return on your investment? You calculated dividend income plus your capital gain 4500. So how much will you receive if you sold this share at the end of the year? You also calculated that to be 2700, and you understand that the difference between your earlier investment and the capital gain you got is your total return on your investment. All this you have done. Okay, and what is the percentage return? You calculated two ways. One was your total return divided by the initial investment, which was 20% you calculated. Okay, other way is the dividend yield plus the capital gain yield. Capital gain yield we are writing, not losses, because if it is negative, it will come with a negative sign. It comes to same. Okay, so it has two part, dividend yield and the capital gain yield. So this also you calculated as 20%. Okay, now if there is a decrease in the share prices to 200, you calculated that there is a 10% loss. So you have a loss of 10% on your investment because the negative capital gain or capital loss is there. This is still where we have completed. Done, all of both of you? Audible or not?
Yes, ma'am.
Okay. So
Yes,
now,
ma'am.
now see what is the risk involved. You can understand from this calculation that the risk involved is the volatility of the secondary market, because dividend income is secure. It did not fluctuate. 20%, 30%, 40%, whatever the company announces in the dividend part, that is secured. You will be getting that. What is fluctuating is the share price part, which is subject to the market volatility. So it will deviate, gain, losses, depending upon when you are going to sell the share, what is the market price that time. Okay. So unrealized capital gain or loss. If the investor, suppose you, what we calculated was you just sold off the share at the end of the year. What if you didn't sell it? We keep the share for long years, 2-3 years, 4 years, 5 years. It is up to you. If you don't like, you don't sell the share. So if you are not selling the share, this is what is known as the unrealized capital gain or losses. Every year there will be some gain, some loss that will go on getting accumulated. Okay, so unrealized capital gain and loss means when the shareholder does not sell the shares, then his unrealized capital gain or loss go on getting accumulated. Okay, so at the end, when you suppose after 5 years you decide to sell up the share, so what is the summation of each year gain and losses is what you will get it as the unrealized, whatever the net. At that time you have got a capital, net capital gain or loss, it depends. What type of share you had, how much gain or loss you had, what is the net ultimately after 5 years or 6 years when you are selling up the shares you are getting. Okay. So we are going to calculate this. If you are accumulating the share over a period of time, then what will be your average rate of return at the end? For example, suppose you hold the share for 10 years of a company. So we are going to calculate what is your average rate of return. Now you see, write the average rate of return of an investment. See the definition and write. Average rate of return of an investment is the sum of the various one period rates of return divided by the number of periods. So every year you will be getting some return, which is your summation of dividend yield plus your capital gain or losses. When you take the summation of this at the end is what you will get as the average rate of return. Okay. And you see a question given here that you are given a yearly return of Hindustan Unlimited. Calculate the ARR on this investment for a period of 10 years. So you have got the share of this HUL and you have held it for 10 years. You have to calculate at the end when you are selling up the share at the end of the 10th year, you have got a, what is your average rate of return? You got a net gain or loss we are going to calculate. So this session will get login in 1 minute. Meanwhile, what I'll do is I'm sending you an Excel file. Okay, all of you are having the laptop or not?
Yes, ma'am.
Okay, so you have to, yes?
Yes, ma'am. I was
Okay.
just
So
saying yes.
I'm mailing you the Excel file. You will download that Excel file. We'll be working on that file now. Okay. So this session is going to get log out. Meanwhile, you will join after 7 to 8 minutes. I'll inform, and by that time you will download the Excel file. I'm mailing you. So before that, you just write this average rate of return of an investment is the sum. You just take the definition of this definition given here.